Today, the RBA says that pain time is coming. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and properties with a distinctively Australian flavour. Well, yesterday, the RBA gave evidence to Parliament referring specifically to the $350 billion worth of fixed loan credit, which will be rolling to variable. The central bank has said it expects about half of all outstanding fixed loan debt to change to variable rates in 2023. Just how many fixed loans will be forced to jump off the mortgage cliff in 2023 is actually hard to determine, but back-of-the-envelope calculations puts it at around 800,000 loan facilities, the RBA said. Speaking at Wednesday's Senate Select Committee on the Cost of Living, the central bank's Marion Kohler, head of its Economics Analysis Department, and Tom Roswell, its deputy, attempted to answer a series of questions about how Australians were being impacted by rising rates and their mortgages. Asked by the Senate committee what the RBA's view was on the quantity of fixed rates that will transfer to variable rates in the calendar year 23, Ms. Kohler replied around 1/3 of the outstanding housing credit is fixed. We think about half of that is due to roll off in the coming year. You can do that in billions of dollars. That's how we look at it, typically about a loan. So $350 billion is roughly the amount of credit that is rolling off. And when asked about how many loans that represented, Kohler said that it was quite difficult to answer that question. The team is actually looking further into that, but you need to do a little bit of back-of-the-envelope calculations, she replied. We do have an idea of what we've called loan facilities, and the number is somewhere in the high 800,000s that you'd be looking at, but that is not 800,000 households necessarily. The reason given by Ms. Kohler is that there would be people who might have more than one loan facility or have taken out a loan with different banks, or they may have a split variable loan rate. So it's a bit hard to put the exact number down when we say that a person has a loan, so that's likely to be a little bit less, she confirmed. But that's really a rough back-of-an-envelope calculation, as I understand it, and it's in the high 800,000s. And in their opening statement to the Senate committee, the RBA representatives acknowledged that a rising cost of living environment puts pressure on household budgets across the country. Many people are understandably concerned about how they and others will manage through a period when the cost of living have increased considerably, they explained. The cost of living pressures currently being faced by all Australians are a result of a substantial rise in the rate of inflation over the past year or so. Annual inflation, as measured by the Consumer Price Index, has increased from a little below 2% in the years immediately prior to the pandemic to around 8% at the end of 2022. Prices have risen significantly for many of the goods and services that people. Today, the higher cost of living is front of mind for many more people than was the case in the years up to the pandemic. The RBA appearance at the committee comes as the central bank prepares to announce its first cash rate call for the year, and most economists have forecast that the RBA will likely increase the official cash rate by 25 basis points next Tuesday as it looks to curb high inflation. But interestingly, of course, there was no discussion nor any recognition that in fact the RBA itself was a prime mover in creating the massive inflation we've got because they took rates way too low through the pandemic period. And it's funny how their narrative appears to be myopic at the moment, missing the elephant in the room, which is that they were part of the problem. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.